Welcome to The Explainer. Today we are jumping right into a huge topic, investing in stocks. We're going to use the official NISM Series XA syllabus as our roadmap. So whether you're studying for the exam or you just want to get inside the head of a professional analyst, you are in exactly the right place. So here's our game plan. We're going to start with the absolute basics. What even is an equity? Then we'll get into how to manage the risks that come with it. After that, we dive deep into the world of analysis, look at the tools they use to value a company, and finally, we'll peek beyond the numbers. Let's get started.
Okay, let's kick things off with the most basic question of all. When you buy a stock, what is it that you're really buying?
Okay, so this is the fundamental difference. Equity means you're an owner, a part owner of the company. If things go bust, you get whatever's left after everyone else, the lenders, the suppliers, gets paid. It's high risk, high reward. Now, debt is totally different. You're not an owner, you're a lender. You've given the company a loan and you have a contract that says you'll get paid back with interest. It's safer for sure, but your upside is capped. You'll never get more than what you're owed. That's the trade-off right there.
So we just established that with equity's higher potential reward comes higher risk. The obvious next question is, how do we handle that risk? How can we protect ourselves without just, hiding our money under a mattress? Let's get into it.
The number one tool in your risk management toolkit is diversification. It's that old saying you've heard a million times, don't put all your eggs in one basket. And it really is that simple. It comes in two main flavors. First, you've got cross-sectional, which just means spreading your investments across different sectors. So if the tech industry has a bad year, hopefully your healthcare stocks are doing just fine. Then there's time series diversification. This is about investing consistently over a long period. It helps you average out the wild swings of the market. You know the saying, it's about time in the market, not timing the market.
And take a look at this chart. It shows you exactly how that can work. The solid line represents the overall economy, doing its usual up and down dance. But that dotted line, that's a counter-cyclical business. Think about things people have to buy no matter what, like basic groceries or medicine. You can see that these businesses can actually hold up pretty well, or even thrive, when the rest of the economy is in a slump. Owning a mix of both helps smooth out the ride.
Now, let's be clear. You can't get rid of all risk. It's impossible, and you have to know what you're dealing with. Some risks, like something bad happening to one specific company or an entire sector, you can reduce with diversification. But then there's market risk. That's the risk that the entire stock market takes a nosedive. You can't diversify that away. And then you've got other sneaky risks, like not being able to sell when you want to, or currency fluctuations if you're investing abroad. Knowing these different types of risk is absolutely the first step to building a resilient portfolio.
All right, so with that solid understanding of risk, we can now pivot to how the pros figure out what a stock is actually worth. And that brings us into the fascinating world of fundamental analysis.
So before we get into the how, we need to understand the who. In the world of analysis, there are two major teams, the buy side and the sell side. Buy-side analysts work for the big money, mutual funds, hedge funds, the people who are actually buying stocks. Their research is top secret because their only job is to find winning investments for their own fund. Then you have sell-side analysts. They work for brokerages, and they're the ones publishing those reports you see with buy, sell, or hold ratings. Think of it this way. The buy side is quietly playing the game to win, while the sell side is providing the public commentary.
So how does an analyst even begin to sort through thousands of stocks? Well, most use a logical process called the top-down approach. It's really like a big funnel. You start at the very top with the entire economy. Are things growing? Are interest rates going up? Then, based on that big picture, you narrow it down to which industries are set up to win in that environment. And only then, once you've found a promising industry, do you zoom in and start looking for the absolute best companies inside it.
Okay, so you've done all that work. You've analyzed the economy, the industry, and the company. Now what? How do you actually turn all that research into a specific price target? That, my friends, is where valuation models come into play.
Generally, there are three main schools of thought here. First is discounted cash flow, or DCF. This is the really academic one, where you try to project all the cash a company will ever make and figure out what that's worth today. Then there's asset-based valuation. Think of this like a fire sale. What would all the company's stuff be worth if you sold it off right now? But by far the most common method you'll see is relative valuation. This isn't about some magical intrinsic value. It's just about comparing a company to its peers. Is it cheaper? Is it more expensive? We're going to focus on this one.
Since relative valuation is all about comparison, we need some standard tools to make those comparisons fair.
And that tool is ratios. Let's break down the most important ones in the analyst toolkit.
And here he is, the king of all ratios, the price-to-earnings, or PE ratio. It's so popular because it's simple and powerful. It basically asks, how much are investors willing to pay for 1 rupee of this company's profits? Now, a high PE isn't necessarily bad. It often just means investors are really excited and expect huge growth in the future, so they're willing to pay a premium for it today. It's a hype meter.
Let's make this super simple. Say a stock costs 100 rupees a share. And over the last year, the company earned 5 rupees for every one of those shares. You just divide the price by the earnings, 100 divided by 5, and you get a PE ratio of 20. That literally means investors are paying 20 times the company's current earnings to own that stock.
Of course, PE isn't the only tool. This table is your quick reference guide. Price to book is awesome for asset-heavy companies like banks. Price to sales is a lifesaver for valuing new, exciting companies that aren't profitable yet. The PEG ratio is a fantastic upgrade on the PE because it puts that number in context by factoring in growth. And dividend yield, well, that's for the income-focused folks. It tells you exactly how much cash the company is paying you back each year just for holding its stock.
Okay, we have spent a lot of time buried in spreadsheets and financial statements. But here's the thing. That's not the only way to look at a stock. Let's shift gears and explore 2 completely different approaches.
This is where we see a real split in philosophy. A fundamental analyst is like a detective, digging through financials to answer one question: what is this company really worth? But a technical analyst? They don't care about that. They believe everything, all the news, all the earnings reports, is already reflected in the stock's price chart. Their only question is, looking at the patterns, where is the price headed next? One is studying the business, the other is studying the market psychology. And here's a perfect example of a tool a technical analyst uses. By simply drawing lines to connect the peaks and troughs of a stock's price, they try to spot a trend. Is it going up? Is it going down? Is the momentum strong? They use these visual patterns, along with things like trading volume, to make their predictions, usually for much shorter-term trades. And finally, we have to talk about the human element. Investing isn't just a math problem. As this quote says, the qualitative stuff, the things you can't just plug into a formula, are just as important. You can have a company with perfect numbers, but if its management is dishonest or its culture is toxic, that's a huge red flag. You have to evaluate the people and the principles behind the numbers.
And that really leaves us with a big question, doesn't it? After you've done all the math and looked at all the charts, how much do you bet on the things you can't quantify, like great leadership or a strong company culture? Mastering the science of valuation will help you pass the exam, but becoming a truly great investor means blending that science with the art of judging people and ideas. And that's the real challenge.